The greatest wealth transfer in history is being hidden in plain sight, not in some shadowy backroom, not buried in classified documents. It's right there on your screen every single time you check the spot price of silver. And today we're going to prove it. With math, with mining data. With the one ratio that Wall Street does not want you to understand. Stay with me. Because by the end of this video, you will never look at the silver spot price the same way again. Welcome back to Gold and Silver Analysts, the channel where we follow the geology, not the propaganda. If you're new here, hit subscribe and tap that bell. Because what we cover on this channel, you will not hear from your financial advisor, your bank, or CNBC. Today's topic is the 7-to-1 mining ratio, and the explosive question it raises about the current silver price. Because here's the uncomfortable truth sitting at the center of all of this. The Earth is producing roughly 7 ounces of silver for every 1 ounce of gold. But the market is pricing silver as if it takes 80 ounces of silver to equal 1 ounce of gold. Let me say that again slowly. Nature says 7-to-1. The market says 80-to-1. So either the Earth is wrong or someone is lying to you. I'll let you decide which is more likely. Let's start with the ground. The actual, literal ground. According to the U.S. Geological Survey and data from the Silver Institute, global silver mine production runs approximately 800 to 830 million ounces per year. Global gold mine production? Roughly 110 to 120 million ounces per year. You do the math. That is a ratio of approximately 7-to-1, sometimes 7.5-to-1. On an exceptional year, maybe 8-to-1. This is not an opinion. This is geology. Now, let's look at where this silver is coming from, because this matters. Mexico, the world's single largest silver producer, pulls roughly 200 million ounces out of the ground annually. The Fresnillo district alone is one of the most silver-dense mining regions on the planet. Peru, the second largest producer, contributes another 110 to 130 million ounces per year. These are ancient silver deposits, the same veins the Spanish Empire stripped for centuries, and they are not infinite. China, Russia, Chile, and Bolivia round out the top producers. Now here's what's critical to understand about silver mining. Unlike gold, where roughly 70% of production comes from primary, gold mines, approximately 70% of silver is mined as a byproduct of copper mining, of zinc mining, of lead mining. That means silver production is not independently scalable. You cannot simply build more silver mines because the price spikes. The silver comes out when the other metals come out. This is a supply ceiling that very few analysts talk about. So let me ask you a direct question, and I want you to sit with it. If silver is geologically scarce, produced at a 7-to-1 ratio compared to gold, why is the market treating it as if it's 80 times less valuable? The Earth doesn't manipulate. Bankers do. Now let's talk about what's happening in the pricing market, because this is where it gets infuriating. The gold-to-silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, currently sits at approximately 80-to-1. Sometimes it spikes above 90, even above 100 during market stress events. The historical average of this ratio, going back centuries, is somewhere between 15-to-1 and 20-to-1. Not 80, not 90, 15-to-20. In fact, the U.S. government itself, when it established bimetallic currency standards in the 1800s, set the official ratio at 16-to-1. That was based on what was understood about natural abundance at the time. Now fast forward to today. With more sophisticated mining data, with better geological surveys, we know the actual ratio is closer to 7-to-1. But the price ratio has gone in exactly the opposite direction. It hasn't converged toward reality. It has diverged away from it, ballooning to 80-to-1 and beyond. In any genuine free market, where price is determined by supply and scarcity, this would be a mathematical impossibility. Think about it in simple terms. If diamonds were found at a 7-to-1 ratio compared to rubies underground, would rubies trade at 80 times the price of diamonds? Of course not. The market would correct. Arbitrageurs would close the gap. Basic supply and demand would function. Unless, and this is the critical word, unless the market isn't free. Unless someone has found a way to manufacture artificial supply that doesn't exist in the ground, and flood the pricing mechanism with it. And that, ladies and gentlemen, is exactly what has happened, and it has a name. They call it paper silver. Let's talk about the COMEX, the commodity exchange. The primary venue where silver prices are officially discovered in the United States. On any given trading day, the volume of silver contracts traded on the COMEX dwarfs, obliterates the actual physical silver that exists above ground. We're talking about paper claims on silver, unallocated contracts, futures positions, synthetic instruments, representing hundreds of millions, sometimes billions of ounces of silver. The total above-ground investment-grade silver in the world? Estimates range between 2 and 3 billion ounces. Some analysts put it even lower. But on the COMEX, contracts representing multiples of that figure change hands every single day. Here's how the suppression mechanism works, step by step. A bullion bank, one of the large institutions with COMEX clearing privileges, sells short contracts on silver. These are promises to deliver silver at a future date at a certain price. These short contracts increase the paper supply of silver flooding the market. More supply in any pricing model means lower price signals. When contracts come due, instead of delivering physical silver, which often doesn't exist in that quantity, the contracts are cash settled or rolled forward. The physical delivery almost never happens. The spot price, which retail investors, industrial buyers, and central banks around the world use as their reference, is anchored to this paper market. The tail wags the dog. The result is a persistent, structural suppression of the silver price, completely disconnected from the geological reality we talked about earlier. Now I want to be direct with you here. This isn't conspiracy theory. Multiple CFTC investigations have examined silver market manipulation. The Deutsche Bank settlement in 2016, where the bank admitted to participating in precious metals price manipulation and agreed to provide evidence against other banks. This is documented legal history. The question isn't whether manipulation has occurred. The question is whether it's still occurring and whether the pricing mechanism you see on your screen today reflects reality or theater. Do you trust the banker's pricing more than the Earth's geology? I'll let that question hang in the air for a moment. Now here's the factor that takes this entire situation and turns up the pressure to critical levels. Silver isn't just a monetary metal anymore. It hasn't been for decades. Silver is the most electrically conductive element on the periodic table. And the 21st century runs on electricity. Each solar panel contains approximately 15 to 20 grams of silver. Global solar installations are hitting record numbers year after year. The International Energy Agency projects solar capacity to triple by 2030. The Silver Institute estimates that solar alone could consume 200 million ounces of silver annually within this decade. Each electric vehicle uses roughly 25 to 50 grams of silver in contacts, sensors, battery management systems, and charging infrastructure. As EV adoption accelerates globally, this demand curve is pointing straight up. Your smartphone, your laptop, medical imaging equipment, missile guidance systems, satellite components, silver is inside all of it, and it is consumed. It is not recycled back into the market in any meaningful volume. Here's the brutal supply picture this creates. The Silver Institute reported that in recent years, physical silver has been running a structural supply deficit, meaning demand exceeds mine supply and recycling combined. The gap is being filled by drawing down existing stockpiles. Stockpiles that cannot be replenished overnight. That cannot be conjured up on a COMEX terminal. So while the paper market suppresses the price, the physical market is quietly consuming the very metal that price is supposed to reflect. This is a pressure cooker. And the lid is getting tighter every single quarter, so let's bring this home. Let's talk about what you, the person watching this right now, should actually do with this information. The paper markets are pricing silver at 80 times below gold, based on a supply mechanism that is, at its core, a fiction. The geological reality says 7 to 1. The industrial demand curve is accelerating. The physical supply deficits are real and documented. And the historical mean of the gold to silver ratio, going back centuries, suggests silver is one of the most asymmetrically undervalued assets on the planet right now. The move from paper illusion to physical certainty isn't complicated. It means owning the metal itself, not an ETF, not an unallocated account at a bullion bank, not a futures contract that gets cash settled into oblivion. Physical silver, in your hand, in your vault, under your control. When the paper pricing mechanism eventually cracks, and history tells us these distortions always correct, the investors holding digital promises will learn exactly how much those promises are worth. The investors holding physical silver will be holding something the Earth spent millions of years creating and that no bank can print. The question I want to leave you with tonight isn't whether you believe in silver. The question is whether you trust the banker's spreadsheet more than the planet's geology. The Earth mined 7 to 1. The market priced 80 to 1. One of those numbers is lying to you. If this video opened your eyes, share it. Someone in your circle needs to see these numbers. Drop your thoughts in the comments. Tell me, what's your target price for silver when this ratio corrects? The conversation down there is always worth having. And if you haven't already, subscribe to Gold and Silver Analysts. We follow the geology. We follow the data. And we will not stop asking the questions the mainstream financial press refuses to ask. The next one, we're going deep on COMEX registered silver inventories and what the recent drawdowns are actually signaling. Until then, stack smart. Trust the earth. And never stop asking who benefits from keeping silver cheap.